If you happen to be under the age of 30 and you have yet to start investing, either because you feel that it's too complicated to figure out yourself, or perhaps you don't want to pay a financial advisor just yet because you don't think that your extra cash laying around is enough to be worth it, or perhaps you're just waiting for next month's paycheck, which eventually leads to next year's paycheck, and eventually you wait until it's maybe a bit too late. Well, if this is you, then you're probably not the most active investor and you prefer to keep things passive and laid back, which is totally fine, but this specific video and this specific ETF will be perfect for you. If you guys are new here, my name is Logan Fisher and his name is Santa Claus, and together we are making videos about personal finance, investing, and overall wealth building. And if you guys would like to be so kind and subscribe, you can follow along with my personal journey to financial freedom and hopefully early retirement. And who knows, on December 24th, we might just follow Mr. Santa Claus in his journey delivering all the toys. But if you guys do choose to subscribe and follow along, you'll be able to see all of my successes, but most importantly, the many, many mistakes that I will make along my financial journey. That way that you guys can choose to maximize your own time as well as money invested so that you can build wealth at a much quicker rate than I do. If you're maybe unfamiliar with what an exchange traded fund is, that is 100% okay. I will go ahead and blame it on our public school systems, because obviously it's much more beneficial for me to know that C6H12O6 is glucose. That's much more important and useful than, let's say, I don't know, managing a budget, or the fact that I know the Pythagorean theorem because in everyday activities I am going to be needing to find the angles of triangles rather than maybe filling out my taxes properly and understanding deductions. The most simple form of what an ETF actually is let's say it's a basket of assets. And these assets can either be stocks, bonds, or even commodities such as precious metals and oil. But it's basically a way to well diversify your investment, and these ETFs, or exchange traded funds, are often made up of at least dozens, but sometimes hundreds or even thousands of different assets all grouped together in one fund. That way that you can diversify and lessen the risk of your investment. When looking at XLK in specific, it is definitely a technology-focused ETF, mostly in stocks. I think it's actually entirely stocks. But anyways, their two top holdings, Apple and Microsoft, make up over 37% of the total portfolio, meaning that it's maybe not as well diversified as what someone that's maybe nearing retirement would like to see. For example, the Vanguard Total Stock Market Index, also known as ticker symbol VTI, has a total of 3,592 holdings. And of course, their top two holdings are also the same top two as XLK, Microsoft, and Apple. But in this case, those two companies only make up 6.5% of the total ETF's allocation, rather than with XLK, of course, we mentioned was at 37%. Meaning that this Vanguard Total Stock Market ETF is much more suited for the investors that are maybe nearing retirement and want a lot more safety with their investments. But it's also very important to note that XLK will most likely outperform the total stock market in terms of growth in the long run. That means that this specific ETF, XLK, is probably mostly well suited for young investors like myself that have plenty of time to rebound if a crash were to occur. And we are willing to take on more risk for much more growth long term. Since the crash of '08 occurred, the whole entire stock market has actually rebounded pretty nicely. It made up all of its lost profits by 2011 and has since just been on a crazy bull run upwards. Lately, I guess we have been experiencing some more volatility with trade wars and news like that, but we have specifically seen the tech sector dominate since 2008, and a lot of expert analysts are actually expecting the tech sector to be an increasing bubble that is nearly about to pop. But my personal take on this is that those expert analysts I'm sure they're still going to continue to use their Microsoft, Netflix, and Google products. Actually, they might even be using Twitter right now on their Apple iPhones to rant about this so-called bubble that's going to burst. Therefore, I personally think that although these tech-focused stocks are very volatile when compared to the Walmarts, the Pfizers, Johnson & Johnson, and Coca-Colas of the world, I don't think that a specific tech sector fall will occur anytime soon, or if ever for that matter. I think that there would need to be an entire market fall like we saw in '08 in order to bring some of the giants down. And because of this personal opinion, I am choosing to look for tech-focused ETFs such as XLK here. That way I can spread out my investments and diversify a bit while still investing into volatile, high-growth companies such as Facebook, Apple, Microsoft, MasterCard, and many more. Here on XLK's top holdings, you can see some of the most successful and innovative tech companies of all time. There are some big names here such as Intel, Cisco, and IBM, but to be 100% honest with you, I have no idea what Accenture PLC is. But I do know that there are people much more intelligent than I am that know exactly what this company is, and that's what's so great about ETFs and investing passively. They don't require you to constantly study balance sheets of new prospective companies that you'd like to invest in. They don't require you to simultaneously keep your eye out for dozens of companies that you own on the news headlines. They're run by these huge institutions that have track records of success for decades, and they know exactly what they're doing when it comes to managing these funds. But probably my favorite aspect of what an exchange-traded fund offers is that they do all the heavy lifting, like I mentioned, at only a fraction of the cost which traditional mutual funds offer. We all know that Uncle Dave Ramsey obsesses over mutual funds, but to be honest with you, I don't agree with much of his investing advice whatsoever. I think Dave is perfect and phenomenal if you're struggling with debt and you're looking to get back on an even ground financially. But I think if you're trying to build long-term wealth, he's kind of stuck in a time warp back in the 70s and 80s. He's still grinding out mutual funds that charge cost bases triple, quadruple, even 10 times that of what Vanguard's low-cost ETF and index funds can provide. As for the dividends that you see here that XLK provides, they are expected from a technology-focused fund. But what is most important to notice here is the consistency of growing their dividend each year for the last 9 years in a row. This is a very promising sign, and I expect to see more of the same for the following decade, or at least until we see this big recession that everyone seems to be scared of come to fruition and cause the ETF to possibly cut their dividend. So although I do love this ETF, XLK, it actually was once 50% of my total Roth IRA retirement fund. And yes, you heard me correctly, it once was. I have since found an ETF that I prefer, and I knew that I was going to be focused in the tech sector long term, so I wanted this to be a focal point in my investing, and I did as much research as I could, and I wanted to squeeze every dollar I could, so I found a better alternative. And this is actually a very, very similar ETF. It's actually VGT, the Vanguard Informational Technology ETF. So as we can see here, it has slightly outperformed XLK historically, and it also has a lower expense ratio at 0.1% versus XLK's 0.13%, which it's not much at all, but in the long term, looking at tens of thousands of dollars, that small, tiny advantage proves to be a very powerful one over the course of 3 or 4 decades. But the very important part to take away from that last slide there was that both of these tech-focused ETFs have pretty well easily dominated the S&P over the last decade. And if you share the same opinion that I do, that our technology will only continue to innovate and control more aspects of our lives, then it might not be a bad idea to go ahead and consider one of these two ETFs. Or if you really, really want to diversify, I guess you can go with both of them. But I prefer VGT after several hours of studying and comparisons, but it's totally up to you. I think that if you are possibly under the age of 40 and you're willing to take on some more risk for potentially higher growth, then these two funds are perfect for you. But what's even better than just owning one of these ETFs is owning one of them in a tax-advantaged account, such as a Roth IRA through Vanguard. This allows me to personally collect dividends and allow the investment to grow until I am 59 and a half years old, and then I will be able to take out all of the gains completely tax-free. If you're a potential young investor that is looking to capitalize on this huge advantage by using a tax-advantaged account such as a Roth IRA, my main advice for you is to stay consistent. Whether the market is up or whether the market is down, do your best to try to max that account each year and invest. Just simply invest rather than waiting for the market to crash, because they often say that time in the market will always beat timing the market. If you'd potentially like to learn more about investing with a Roth IRA or even learning what a Roth IRA is, I have videos down in the description below that will tell you what a Roth IRA is, and another one will actually show you how to invest in a Vanguard Roth IRA via the mobile app. So that's all I have today for you wonderful humans. If you could go ahead and please leave a like down below and consider subscribing, that would be greatly appreciated. Thank you guys very much, and I'll see you next time.